Americans can have confidence that the banking system is safe. Your deposits will be there when you need them. During the Obama-Biden administration, we put in place tough requirements on banks like Silicon Valley Bank and Signature Bank, including the Dodd-Frank law to make sure that the crisis we saw in 2008 would not happen again. Unfortunately, the last administration rolled back some of these requirements. I'm going to ask Congress and the banking regulators to strengthen the rules for banks to make it less likely this kind of bank failure would happen again. Look, the bottom line is this. Americans can rest assured that our banking system is safe. See you in California.
Mr. President, what do you know right now about why this happened? And can you assure Americans that there won't be a ripple effect?
Do you expect other banks to fail, Mr. President?
We are so screwed. Joining me now, Carol Roth, not only a recovering investment banker, author of the book the whole book's going to come true. I know it is. The book is called You Will Own Nothing. It would be a really good time to purchase that if you want to know where we're going. Carol, don't worry. Congress is going to step in and fix all this now. Okay, you know what? Let's set Biden aside for a minute because I know we're all pressed for time today. You most definitely are. FDIC, Silicon Valley Bank, pretend like I'm an idiot. What happened?
Well, that's a big stretch for me, Jesse, but I'm going to buckle down here and try to pretend like you're an idiot. So basically, when you have Joe Biden coming out, it's the arsonist who has burned your house down coming out to reassure you that they've got the water, that they're, want to take credit for now putting out the fire. And what has happened, as we've discussed before, is we have had the Federal Reserve and the government basically playing God, and particularly the Fed is artificially suppressing interest rates for basically the last 15 years. And this got accelerated again with the government's response to COVID. They, again, took interest rates, their target interest rates to near zero, put out lots of capital into the market. So what happened was all of these companies and individuals were flush with cash, and particularly in certain areas, like in Silicon Valley, companies raised a lot of money and they wanted to put their money into the bank. So they went to Silicon Valley Bank, who has been a longtime friend to founders and startups, in Silicon Valley. And that bank increased its deposits by basically, they tripled them between 2019 and 2021. The challenge is when banks take in deposits, the way that they make money is by turning around and lending that money out at a higher interest rate, and then they make that differential. They didn't have enough people who needed loans to loan that money out to. So in the interim period, they decided they needed to do something with the capital. Now, here's where it gets really weird. They think, okay, we're going to put them in some quote unquote safe securities, things like treasuries, the notes and bonds that the government issues. But they go out and they lock them down, not for 30 days or 3 months or a year, but for 10 years. Basically betting that the Fed would never raise interest rates again. But then we know what happened. Inflation got out of control because of all of this stimulus and all of this artificial suppressing of interest rates and all the supply issues caused by Biden and shutting down our energy supply, this huge snowball. And when they had to go back and raise the rates, a couple things happened. First of all, depositors went, well, why do I have my money in the bank earning next to nothing here? I'm going to go find a higher paying bank, or maybe I'll even invest in a treasury security, which, as of like last week, you could get like 5% on a very short duration treasury security. And then other people with the economy going on found their businesses maybe needed some operating capital. So the withdrawals from the bank started happening at a higher rate than was expected. And all of this money, all this extra money is tied up in 10-year securities. Now, when interest rates go up, the value of that security goes down. There's an inverse relationship because basically, why would you buy a bond that's paying a smaller interest rate when you could get a higher interest rate once? So they were forced to sell some of those securities and take a loss on that. And that whole sort of thing started snowballing out of control. Now, had they held them to maturity, by the way, they would have incurred no losses. It's not like it was a toxic loan. So this was basically a Fed-created situation where they fixed the interest rate really low, drove up the supply, and then created this scenario where then they drove up the interest rate, and this bank was stuck in the middle. Why they didn't come up with a solution to this before they communicated it to the market and basically created a bank run is one of those things I still cannot wrap my head around. I don't know if it's just complete arrogance and being so isolated that they didn't understand that this was going to be the implication of what happened when they communicated it, particularly in a close-knit community like Silicon Valley, where everybody's talking on Slack and WhatsApp. And, when they realized, one other piece of this is that so many of these depositors were not insured. They were above that $250,000 threshold from FDIC insurance because they were companies. They were companies that put their cash that they managed their business with in here. That was part of the panic too. So all of these things kind of created this perfect storm, a very different scenario than had this bank made toxic loans or made risky derivative bet. It's just like literal stupidity that starts and ends with the Fed and the government.
Okay, so who got bailed out? We're all seeing all these headlines today, FDIC, and people think it's 2008 again, which it's not yet. But as of now, who got bailed out? What's going on?
Okay, so I know that this is not popular, particularly amongst many of our friends, but the reality is this was probably the right thing to do at this stage. I mean, frankly, they should have done this before it was a panic, but given the fact that it was a panic, this was the right thing to do. Who got bailed out are the depositors, the people who have trust and faith in the financial system. It's not the shareholders. The shareholders are not getting made whole. The management team has been shown the door. So it's not like they are bailing out these people who did all of these bad things. This is a bad outcome, but they're trying to put in place some confidence that if you have your money in a bank, that you don't have to worry about creating a bank run and a panic because the same thing won't happen. And I challenge people, if this bank had been called the Small Business Bank of Iowa, and it was a bunch of other small businesses that had their money in there, you would probably be singing a different tune. I know nobody likes Silicon Valley and the rich tech bros and whatnot, but think of the ripple effects throughout the system. One of the things I saw on Twitter, for example, was Etsy, which is a marketplace where you can buy crafts. I'm sure your wife gets like her cute little pillows that you talk about there, something like that. But a lot of artists and entrepreneurs sell their wares there. And Etsy, as a marketplace, does their banking in part with Silicon Valley Bank. So they sent out a note to their customers saying, we're not sure when we can pay you. Do you want the little artist to not get paid because of this chain reaction? Now, obviously, what the Fed and the Treasury did will now allow that to, hopefully get paid. But those are the kinds of chain reactions. And if they hadn't done something, this was going to be a contagion that would have spread to other regional banks and would have just been a mess. So it's not, obviously, I'm a capitalist. It's not a traditional bailout.
I know. My question to you is this, and I really want to know, because I saw this quote: "No losses associated with the resolution of Silicon Valley Bank will be borne by the taxpayer." Okay, so you say we're going to make some business whole who invested and they weren't going to get all their money back. Who's going to be doing the making of whole here? Where's this money come from in the beginning?
Yeah, so the reality is the taxpayer always pays for everything. If you either pay for it directly through raising taxes, you pay for it through the erosion of the purchasing power of your dollar, you pay through it through more fees from the bank. As I mentioned, this wasn't an insolvent business. I mean, the Fed can come in and loan against this portfolio, and there's probably not that much of a differential that they need to solve for here. What I have heard, and this is all unfolding, so this could shift. This is just my interpretation right now, particularly for the two banks that they were just addressing, Silicon Valley Bank and Signature Bank, which, oh, by the way, Barney Frank of the Dodd-Frank architecture sits on the board of. But what they were planning to do is that they were going to, I guess, the easiest way to say it is expand FDIC, which is paid for by fees from the broad set of banks. So my guess is that in this particular case, the broad set of banks will be given some sort of a fee assessment, and how that will hit you. It means either you're going to earn less on your money or they're going to charge you additional fees. So yes, you indirectly do end up paying for it, but just not through a traditional tax hike.
What a shock. Real quick, Carol, I know we've kept you long. I'm sorry. Just real quick. Signature Bank, you brought it up. We didn't have time to get to it. Are we anticipating some bad financial stuff to snowball from here? Everyone thought, what if there's another one? Now there's another one. What do you anticipate from here?
I mean, it really depends on how people react to the president, which I know doesn't give you a lot of confidence.
Oh,
Did they hear Joe Biden and go, yes, I feel like my deposits are secure? So assuming people settle down, there's going to be more fallout. There's some crypto contagion. There's some other things that are going on that will probably have some fallout. But hopefully these actions have sort of quashed panic for people running in and just, wholesale pulling out all of their deposits. However, as we get more details on how they might, quote unquote, backstop other people's deposits, things could shift very quickly. So it's far from over. Make sure you go to your own bank or financial institution. Make sure you're FDIC insured, or with a credit union, it's NCUA. If you have securities, make sure they're SIPC insured. If you're over any threshold, move the money around in a way that they are protected by that level of insurance. And long term, make sure that you have some of your money in hard assets, a form factor you can control, because nobody can come to your house and do a run on your gold and precious metals and things like that, without encountering you with a shotgun. So that's my 2 cents.
Carol Roth, thank you. I know you're going to have a whirlwind of a media day given all this news. Thank you for giving us some time. We appreciate you.
Support the First TV today and get instant access to exclusive specials like Who is Ron DeSantis, the history of FBI scandals, and America's worst presidents. Visit thefirsttv.com/support or download the First TV app to become a supporter and start watching today.